Good everyone, welcome back to our next edition of Econ Talks. Gareth, we've had some more housing market data come out showing that, look, the housing market is still not where it was back in 2021-22, but starting to see a little bit more momentum underlying, a little bit more price activity, starting to come a little bit more out of the doldrums, not going fast by any stretch of the imagination, but starting to pick up a little bit of momentum perhaps.
Yeah, I mean, people have been talking about the housing market and looking at it and going, okay, it needs to sort of start responding to those lower mortgage rates coming through from the Reserve Bank and the OCR cuts. And there has been a bit of momentum building, like you say, probably over the last 6 to 9 months, but it is incredibly gradual. Sales are sort of just tracking up ever so slightly a month on month, and I think they're up about sort of 9%, 10% on where they were a year ago. House prices, a little bit more positive news there. Of course, we saw house prices coming under downward pressure through 2024. They have been a bit patchy over recent months, like a lot of economic indicators, but the latest monthly figure showing prices up 0.4% from where they were in March, and still down on a year ago by about 0.3%, but those annual falls are sort of diminishing. And we are seeing some regions now, not a lot of them, but some regions where annual price growth is just starting to turn a little bit positive as well. Other, I guess, signs of life in the housing market include stock numbers, where they're still close to 10-year highs, but again, just edging down ever so slightly month on month from where they have been previously. And the length of time that property's on the market as well, just showing signs of coming down a little bit. But again, it's been volatile month to month, so it's difficult to read too much into any given month. And it is still well above both the average of the last decade and, of course, anywhere near where we got to when the market was very hot during 2020 and 2021 as well. So you take all of that together, and it's a case of, I think, as we had been expecting, a little bit of gradual improvement coming through in the housing market, maybe more to come later in this year as well, but certainly not enough to get real estate agents, I don't think, particularly excited about people banging on their door wanting to buy a house.
No, definitely not, especially when if you look through all those figures, it really does still suggest that although probably a few more sellers are becoming a bit more realistic about the prices out there in the market, there's still quite a few who will be looking at previous valuations and similar and going, I'd like that big number, please, not adjusting to where the market actually sits at the moment. So those high stock levels, although it's, I think, encouraging they're not continuing to increase, if you're in the housing market, you don't want them there to be even more stuff that's got to be sold. But they're certainly not sort of crashing back to earth or similar, like you say, they're still sort of near those 10-year highs. I think interesting as well how this is playing out in terms of people's mortgages and what they're paying for. Of course, we knew that as the official cash rate came down, the rates that are being published by banks that you can go and get a mortgage for, they've been coming down too. And we have been tracking some of that data that the Reserve Bank puts out, showing that actually there has been a real shift, even just in the month of March alone, towards a little bit more fixing and off for a little bit of a longer period, because people have been sort of going, look, there are some not too bad, some pretty attractive rates out there. We saw for, I think, 28% of new mortgage lending go on a 2-year fixed term in the month of March. That's the largest 2-year proportion that's been fixed on 2 years, I think, going back to 2023. So there is a little bit of, I think, people looking at some of those sharp rates just below 5% and going, geez, I'd take the stability of a much lower rate than I was on before. Then that sort of, certainly a floating rate, or even some of that shorter term stuff. And interestingly, you look at the amount of lending as well on the 1-year terms, again increasing, but the amount of funding going into the likes of 6-month rates really pulling back the same with the likes of that floating. And I think people are having to make this calculation now of going, look, there's the potential certainly for interest rates to continue to go lower. But like if I lock in at the moment when there's maybe not huge amounts left to go, then geez, I sort of do get that stability of that lower interest rate sooner rather than later, rather than, taking a floating and there's still a pretty big margin there, or even at this point taking a 6 months and going, geez, there's still a bit of a margin there, and I've got to sort of really expect that things keep coming down, even though, inflation's starting to accelerate again just a little bit. Reserve Bank hasn't talked a big game about wanting to, slow back on their cuts. They've still got a few more they think loaded into the chamber. But again, from a household perspective, you really are just looking at things and going, oh, a bit of stability might be nice. I mean, looking out at things, Gareth, in terms of what the Reserve Bank wants to do, but also from a household perspective there, are you surprised to see sort of such a sharp switch from that sort of shorter end 6 months or floating towards that 2 year? Is it just a bit gimmicky at the moment, or do you think that trend's here to stay?
Well, of course, we saw some of the banks, pretty early on coming in with those rates at just under 5%, like you say, for specific terms. And I think people would have looked at that and gone, oh, it starts with a four. It might be 4.99, but it's still starting with a four. And that does look pretty attractive. So I think there has been probably a borrower response to that in terms of shifting towards that. What we're seeing at the moment across the market is whether it's 1 year, 18 month, 2 year, they're all sitting now generally at around about 5%. And so, there's neither here nor there. And the 6 month rate's still up at 5.5. So, like you say, if you're going to go with the 6 month rate, you'd have to be betting on another 50 basis points coming off the retail rates, the 1 year rate, for example, over the next 6 months. Now, at the moment, financial markets will have priced in another couple of OCR cuts anyway, taking the OCR down to 3% by July. So that those cuts are not really going to shift the dial in terms of where fixed mortgage rates go. Where the downside risks to interest rates potentially come, you've talked about inflation and maybe some of the upside, almost upside risks there. Where the downside risks, of course, are coming from potentially is the global situation and just how that flows through in terms of impacting on New Zealand's economic recovery going forward. And certainly there are some forecasters talking about potentially the OCR going down by a further 50 basis points down to 2.5% in response to that, if inflation and inflation expectations remain well anchored and under control, and that growth outlook does continue to deteriorate. So there is a sense that maybe households, if they're fixing now for that length of time, could miss that downside risk. But the thing is, it is a risk, right? It's not the central scenario, I think, in terms of our thinking. And so taking that stability at a rate that looks reasonably attractive and certainly a lot more attractive than the 7% plus you were faced with 18 months ago, it probably makes a great deal of sense. And households going, so what if I miss a little bit on the downside in terms of further interest rate cuts? I know I can cope with these mortgage repayments going forward. I want the stability, lock it in for 2 years in some cases, and away we go. You can go and sleep easy. So I think that's probably the approach being taken. Also seeing a little more investor activity coming through in the market, but generally speaking, it's sort of steady as she goes around that.
Which I think is, a much better place, right, for the economy to be, and certainly better for consumers to be in when they're thinking about things and going, look, I could sort of, almost literally bet the house on interest rates coming down a bit further. But geez, for the moment, getting into a more comfortable spot where I'm not stressing as much about my spending day to day and making those higher mortgage repayments, geez, I'll sort of just take the stability because it is a much better spot, like you've highlighted. Again, a lot of people still also refixing their interest rates. Not everyone has redone that. The proportions we were talking about before, those are just for new lending. But of course, as we go through the year, there's a whole bulk of stuff that's going to be unwound. People are going to come up for refixes. And again, it's sort of that second half of the year where I think the impact shows through. Consumers a little bit more confident, they've got a bit more money, and then eventually they'll likely spend a bit more of it too. We'll assess all of that, including how those refixes go, what sort of mortgage rates people are taking, and what that does to the likes of the housing market on one of our future editions of Econ Talks.